Mike, I have been listening to Mr. Market over the last few days, and despite what turns out to be a very strange political system they have in this country, the message from Mr. Market has been, we can handle this. There was a couple of hours on Friday morning of indiscriminate selling after the news of the vote came through, but quickly after that, selling became very discriminate. Only certain sectors were hit. And if we go, for example, to my first chart, these are three UK stocks that should be quite sensitive to the Brexit vote. So the two on the bottom are Virgin Money, a small cap UK bank, Persimmon, a UK house builder. You see they had their big drop on Friday. They fell precipitously through the end of the day on the 27th. But though it's hard to see on this chart, buyers came in. From the bottom, these stocks are up 10, 15, 20%. Ted Baker, which makes clothes, predominantly a UK company, very sensitive also to consumer sentiment in this country, same pattern. It fell, not as much, tumbled a little more, but it's had a nice comeback. So, yes, there's been a shock, but yes, the market has been discriminating, and buyers have come in at the bottom. So, deep breath.
Good points, Rob. Look, markets expected a Remain vote. So effectively, Mr. Market took a right hook on Friday morning. And he hit the canvas, and what you're seeing here, he's getting back up off the canvas.
Yes.
The bigger takeaway here is that today is the end of the second quarter. We're at the halfway point of the year. This recovery is a trading opportunity. Whether it's a longer-term investment opportunity remains to be seen. We simply don't know what Brexit really will mean for global markets, for UK markets, and in particular for the European markets. But at the moment, it's a buying opportunity over the last 2 days, and you're going to see people flip stuff out here before the end of the quarter. But the real question is what happens next week. So if we go to the next chart, which I believe shows sterling.
Yeah, sterling has not meaningfully recovered.
You have to look at this as being the key parameter for financial markets at the moment. We've had a complete collapse in sterling. Sterling's drop here is the biggest we've seen in the post-Bretton Woods period of currency trading since the early 70s. More importantly, this isn't one of the sort of post-war or pre-war periods when the Bank of England literally just shifted the exchange rate. This is the market saying, sterling, you're out. And they've hit them pretty hard. And you've seen a bit of a bounce here. But again, most people still believe you're going to see 125, even lower on this chart in the next few months as the political instability continues in the UK and as we sort of look at examine whether or not what kind of deal is Britain going to get in terms of leaving the EU.
But
and what does it all mean?
For an equity investor, is that relevant? I'm still looking at the fundamentals of UK stocks and
it comes down to a trading opportunity. So a lot of the FTSE 100 companies, for example, there are big multinationals with global operations. So a lot of their revenues come
back to where they're FTSE 100.
In sterling terms, the FTSE 100 has come back. It's erased its losses from Brexit, and it's actually up on the month, which is in contrast to a lot of major global indices such as the S&P, which is still down for the month, and of course European equities. But this is the FTSE 100 and the 250, which is the domestic-orientated companies in the UK, priced in dollar terms. So thanks to that big drop in sterling, they still haven't come back to their their sort of pre-Brexit levels. For the FTSE 250, I would ignore the 100. That's a global...
Yeah, those are just global companies.
The FTSE 250 is about UK PLC, domestic companies, and that still doesn't look too good. That's still just crawling up off the canvas. It's holding onto the rope at the moment.
Okay, credit markets are not flashing the red sign either, though, right? Spreads have not blown out. Yields have dropped, but not drastically. The markets seem to be opening. Companies are issuing debt. Is this not reason for calm?
It reflects essentially the idea that central banks are going to come once more to the rescue. We'll see further easing from Japan, European Central Bank, and also the Bank of England is expected to cut rates as early as next month when they meet. The real problem, though, is that while credit looks okay and parts of it are doing better than others, what's the big worry that's coming down the pipe here? And we're seeing signs of it if we look at what's been happening with the European financials this week, and in particular Italian banks. The key takeaway from Brexit is that, okay, which member of the periphery is the next one to go? And a lot of people are beginning to look at Italy. They're looking at Italian banks in particular. Credit markets will gum up if the financial system breaks down, and the financial system always comes back to what a bank's doing. And so really, for the Q3, this is the chart to keep watching, and in particular watching Italian banks and also individual banks such as RBS here. which is not doing too well today. Also, Deutsche Bank, which failed a stress test in the US last night. So banks, at the end of the day, they keep the credit system going, and if they're not looking so good, again, owning credit at the moment, it's a trade. Is it really a long-term investment? Time will tell.
My optimism is bruised but not beaten, Mike. Thanks.
You're welcome.